Okay, let's unpack this. Imagine a part of the economy where no matter what the headlines are screaming, market up, market down, people have to buy this stuff.
Yeah, the real non-negotiables.
Absolutely. The things you use every single day, the essentials, you'd think, okay, that sounds super predictable, right? Like a safe harbor in a storm.
That's definitely the classic reputation.
Yeah.
You know, the ultimate defensive sector. But when you actually dig into it, you find that even this world of like toothpaste and cereal and soda is going through some massive changes.
It's more dynamic than it looks on the surface.
Way more dynamic, yeah.
And that's exactly the deep dive we're jumping into today. We're looking closely at the U.S. consumer staples sector, all the stuff filling our cupboards, often tracked by tickers like XLP.
Right.
And we've got some great source material to guide us. A really detailed forward-looking piece from Deloitte, sector analysis from Trinity SMF, company lists, market data, a real mix.
Yeah, it gives us a good range from the big global economic picture right down to what individual companies are actually doing, their strategies.
So our mission here is to cut through all that information, pull out the really key insights. We want to understand, what are consumer staples, fundamentally? Why are they seen as safe havens? And importantly, what does the 2025 outlook mean for them?
And how are they planning to grow if just raising prices isn't the answer anymore? What are the risks?
Exactly. We want to get to those aha moments about the stuff you literally buy and use every day.
Right, let's get into it.
Okay, so first things first. What exactly are consumer staples? It sounds simple, essentials, but the definition in our sources is pretty specific.
It is. Basically, the core idea is these are products that people are either unable or maybe more accurately unwilling to cut from their budgets, no matter what's happening with their finances.
Things you just find the money for, period.
Exactly. Think about the basics listed in the sources. Food and beverages, obviously, that's huge.
Yeah.
Household goods, cleaning stuff, laundry detergent.
Toilet paper. Can't forget that one.
Definitely not. Personal hygiene products, too.
Yeah.
Soap, shampoo, toothpaste, stuff you use daily and replace almost on autopilot.
Right. And the sources also mention alcohol and tobacco being included in the sector, which, might make some people pause. How do they fit the essential tag?
Yeah, it's less about biological necessity and more about observed consumer behavior, right? From an economic standpoint, spending in these categories often holds up surprisingly well, even during downturns.
Yeah.
For certain groups of consumers, demand is consistent.
So it behaves like a staple, economically speaking, even if it's not, bread or milk.
Precisely. And you see major players like Philip Morris or Anheuser-Busch InBev in the big consumer staples indexes, like the MSCI World Consumer Staples Index mentioned in the material. It's based on spending patterns, not a health definition.
Got it. And that classification really points to the sector's most famous trait. Its stability, its reputation. The sources talk a lot about inelastic demand. That's crucial, isn't it?
Oh, absolutely fundamental. Yeah. If you want to understand this sector, you have to grasp inelastic demand. It just means that even if the price goes up, the amount people buy doesn't drop much, or maybe not at all.
Like your toothpaste example. Price goes up 10%, you're probably not going to stop brushing your teeth.
Exactly. You might grumble about it, maybe look for a deal next time, but you're still buying toothpaste. You need it.
You don't suddenly switch to, I don't know, chewing on a twig because Colgate got more expensive.
Right. Whereas, contrast that with something like a fancy new phone or a vacation, a discretionary purchase. Right. If the price jumps 10%, a lot of people might say, maybe later, or I don't really need it, and sales volume drops significantly. That's elastic demand. Staples are inelastic.
And that inelasticity, that predictability, is why it gets called a defensive sector.
That's the core of it.
Yeah.
Defensive means it tends to perform better, or at least decline less, than the overall market when the economy hits a rough patch or the market gets volatile.
Investors get nervous, they look for safety, and companies selling things people have to buy seems safer.
Exactly. They rotate into sectors where demand feels more reliable.
And there's a really striking statistic in the sources about this from the 2008 crisis.
Oh, it's incredibly powerful. Yeah, the Market Beat source points this out. During the 2008 financial meltdown, which was just brutal for markets globally, the Consumer Staples Select SQDR Fund, the XLP, it only fell about 11.4%.
Okay, 11.4%. Still a drop, but...
But compare that to the S&P 500 index over the same period, it cratered. It plunged by a massive 57%.
57% versus 11%. Wow. That really paints a picture, doesn't it?
It absolutely does. It shows you where people's priorities lie when things get really tough. You cut back elsewhere, but you still buy the necessities.
It highlights that non-cyclical nature you mentioned. Demand doesn't really follow the ups and downs of the economy in the same way.
Right. People buy roughly the same amount of breakfast cereal, whether the economy is booming or in a recession, and that leads to more stable, predictable earnings for these companies.
Which is exactly what investors crave when they're worried about a recession.
Precisely. And the Trinity SMF report actually suggests that a potential economic slowdown could be a relatively good time to look at staples investments, fitting that historical defensive pattern.
Makes intuitive sense. And looking back, the MSCI World Consumer Staples Index has actually outperformed the wider MSCI World Index in several challenging years, right?
Yeah, the sources specifically call out 2010, 2011, 2014, 2015, and more recently, 2022. In those years, staples held up better than the broader global market. It reinforces that defensive quality.
And just to make this concrete, who are some of the behemoths in this sector? The household names.
Oh, you know them all. Think Procter Gamble, Tide, Pampers, Crest, Nestle, huge in food and drinks, PepsiCo, Coca-Cola, obviously. Retail giants like Costco and Walmart who sell enormous amounts of staples.
Unilever,
yes. L'Oreal and personal care. Mondelez with snacks like Oreos and Cadbury. These companies' products are just everywhere.
absolutely woven into daily life. Okay, so that sets the stage. What staples are, why they're defensive. Now, let's look ahead. What's the economic picture for 2025 looking like based on the Deloitte report? What's the global vibe?
The general outlook, sort of the base case heading into 2025, is cautiously optimistic. They're talking about continued growth, hoping for that soft landing scenario.
Meaning inflation comes down without a major recession.
Exactly. The idea is easing inflation, maybe some central banks starting to cut interest rates, hopefully leading to rising real wages where your pay actually buys more and just generally better financial conditions. The global economy actually held up better in 2024 than a lot of people feared.
So some momentum carrying forward.
That seems to be the expectation. Yeah.
But a soft landing globally doesn't mean smooth sailing everywhere, right? The sources definitely highlight regional differences.
Oh, absolutely not. The regional pictures are quite distinct. Let's start with the U.S. The economy there has been surprisingly strong, resilient. Part of that is attributed to companies investing in tech, boosting productivity.
So underlying strength.
Yes. And the expectation is that the Fed might ease policy a bit, which helps. But there's a but.
Always a but. What is it for the U.S. consumer?
Well, despite the overall resilience, the report forecasts a modest slowdown in U.S. economic activity in 2025. A key reason is the consumer. Many are still carrying a lot of debt, delinquency rates are up, and even if rates come down, borrowing costs will likely stay higher than they were before the pandemic.
So consumers might be feeling the pinch even if the overall economy is okay, prioritizing debt over spending.
That's the concern. Spending growth might still be positive, but maybe less robust. Plus, they flag potential wildcards like new import tariffs or changes in tax policy.
Okay, so U.S. resilient, but maybe slowing consumer spending. What about Europe? It had a really sluggish 2024.
Yeah, Europe barely grew in 2024, but the outlook for 2025 looks somewhat brighter. The main drivers are falling inflation, the chance of rate cuts from the ECB and Bank of England, and rising real wages. That should give consumers a bit more spending power.
But Europe has its own longer-term issues.
It definitely does. Things like demographics aren't favorable in many countries. Some governments have tight fiscal policies, and there's increasing competition from both the U.S. and China. These are ongoing challenges.
Is there any potential upside for Europe?
Well, one interesting point raised is the pile of excess savings that European households built up during the pandemic. If confidence returns as inflation eases and jobs remain stable, maybe, just maybe, consumers start spending some of that saved cash.
That pent-up savings idea could be a boost. Okay, turning to China.
China's growth outlook is lower, probably in the, say, 3 to 4% range. They're dealing with demographic headwinds, the property sector is still a major drag, and external risks like potential tariffs are a concern.
So, lower growth trajectory. What about policy response?
Monetary policy is expected to remain loose, but the big question is fiscal stimulus. How much will the government step in to support growth? That will be key. The consumer outlook there is described as pretty modest.
People are still cautious, saving more.
It seems so. Many households are focused on rebuilding savings after asset values fell. Unless there's stronger government support, like a better social safety net or significant stimulus, consumer spending might remain subdued.
Okay, so a global soft landing hope, but with very different stories playing out in the US, Europe, and China. Across all these regions, what's the biggest single risk that Deloitte highlights for these consumer products companies?
It comes back to geopolitics and the risk of supply chain disruption. It's not a new fear, obviously, but it remains top of mind.
Still the dominant concern.
Yeah. For companies that rely on sourcing materials globally, manufacturing efficiently, and distributing widely, any instability conflicts, trade wars, shipping problems is a direct threat. It means they have to focus on making their supply chains more resilient, building in backups.
We all saw how quickly shelves emptied during the pandemic. It's a constant vulnerability they have to manage. So given this backdrop, the economic outlook, the risks, how are staple companies planning to grow in 2025? The sources say the old strategy isn't working anymore.
This is a really crucial shift. The Deloitte report is very clear. The playbook from, say, 2021 to 2023, which relied heavily on just pushing through price increases to drive revenue growth. That's largely over.
That was the main lever for a while, right? Covering rising costs and boosting profits?
It was. It worked for a couple of years. But now,
Yeah.
executives surveyed just don't feel they have that pricing power anymore.
Why not? What's changed?
They're worried about pushback from retailers who are dealing with very price-sensitive shoppers, and pushback from consumers themselves who might just stop buying or switch to cheaper alternatives if prices go up further. People are tired of inflation.
And they remember pre-pandemic prices.
Definitely. The sources mention consumers are still comparing today's prices to 2019 levels. Even if prices stabilize now, that baseline feels much higher.
Makes sense. So just raising prices again feels risky, could alienate customers, hurt volume.
Exactly. And it can also, mask underlying problems with the brand or product if you're just relying on price hikes. So they need other ways to achieve profitable growth.
Okay, so if price isn't the main engine, what are the strategies that the high-performing companies are focusing on for 2025?
Deloitte breaks it down into three key pillars. First, product portfolio and mix. Second, demand generation. And third, transformative efficiency. That's where the energy and investment are going.
All right, let's take those one by one. Product portfolio and mix. What does focusing on mix actually mean? It's not just volume anymore.
Right. It's a shift away from purely chasing volume, selling more units, towards improving the mix of what you sell. Selling smarter, essentially.
Meaning selling more profitable items or items that fit better strategically.
Exactly. The survey data is really telling here. The number of executives prioritizing volume growth has dropped quite a bit, but the ones leading on profitability, they are much more focused on improving the product mix, 79% versus 67% for others.
So the product itself is really back in the driver's seat, and innovation is a big part of that.
Huge. 95% of executives say introducing new products or services is a priority, and investment in innovation is increasing for 80% of them.
But is it real innovation? Or just, new and improved packaging or a slightly different flavor? That's often been the criticism.
That's a fair point, but it seems companies are recognizing that. Nearly 2/3 are specifically shifting investment towards developing truly novel products, not just minor line extensions. They seem to get that they need genuine differentiation to win now.
Interesting. What about the value versus premium debate? Consumers are hunting for value, but are companies ditching their premium lines?
No, and this is fascinating. It's not an either. While 2/3 see consumers trading down to save money, about the same number, 66%, are also actively pursuing premiumization strategies.
So playing both ends, trying to capture the value seeker and the person willing to pay more for something special.
Precisely. It's a nuanced approach. Develop value options, yes, but also create premium offerings with distinct benefits. And they're using tools like precision analytics, 64% are, and even generative AI to identify those specific opportunities and sort of simulate how a new product might perform.
Using data to find the sweet spots at both ends of the price spectrum.
You got it. And another strategy catching on, especially in food and beverage, is what they call occasion-based selling. 85% of execs in that area are focused on this.
Occasion-based selling, what does that look like?
Instead of just thinking we sell snacks, they think we compete for the mid-afternoon energy boost occasion. Or instead of we sell pasta sauce, it's we compete for the quick Thursday night dinner occasion.
So framing it around the consumer's need or moment rather than just the product category.
Exactly. It's about solving a specific problem for the consumer at a particular time. How can our product fit that moment?
Feels much more targeted.
It is. And we talked about those examples earlier, Mondelez, with the unique Oreo flavors in China, like green tea cake or spicy pepper.
Still can't quite wrap my head around spicy pepper Oreos.
Huh. Me neither, but it makes the point, right? Tailoring directly to local tastes and occasions. Or Kellogg's breakfast noodles in Africa, meeting an existing meal pattern, not forcing a Western one.
Brilliant examples of adapting the product. How does this focus on mix affect their existing product lines? Are they cleaning house?
Yes, the high performers are. They call it perpetual portfolio management. It's not just about adding new things, it's about constantly evaluating and removing what's not working. Over half are regularly divesting underperforming lines or businesses.
Making room for growth and focusing resources. And acquisitions are still part of the plan.
Very much so. 60% expect to increase M&A activity, and for the profitable growers, it's even higher, 72%.
And what are they aiming to buy? Just bulking up?
No, it seems more strategic than just scale. The profitable growers are primarily looking to acquire strong brands. That's the priority for 80% of them, and companies that can accelerate their digital capabilities, 74%.
So buying brand equity and digital know-how, not just factories or market share?
Seems to be the focus. It's about building future capabilities.
Okay, that covers product portfolio and mix. What's the second pillar? Demand generation.
Right. This is all about how you actually reach consumers and convince them to buy in today's, very fragmented media landscape and with demanding consumers.
Digital is obviously key here.
Absolutely. 79% are investing more in digital channels and platforms. They have to be where the consumer is, which is increasingly online or using multiple channels.
Are they just throwing more money at marketing in general?
It looks like it. Nearly 7 out of 10 expect to increase their marketing and advertising spend as a percentage of revenue. And since they can't just rely on price, 76% also plan to increase promotions and discounts in 2025.
So more ads, more deals, but how do they make sure that money isn't wasted?
That's where analytics comes in again, big time. 70% see analytics as crucial for optimizing their marketing return on investment, figuring out what actually drives sales, market share, getting people to try the product.
Measuring what works.
Exactly. And almost 3/4 are using analytics to get smarter about their pricing and promotions, who gets what offer, when, at what price point. The profitable growers are really leaning into this. 86% use analytics for marketing ROI.
Trying to be surgical rather than using a scattergun. Makes sense.
And a specific tool getting a lot more attention is revenue growth management, RGM systems. 62% see these playing a major role.
RGM, what do those systems do?
They help companies make really granular decisions, integrating pricing, promotion, assortment, and trade spending to maximize revenue and profit. It's about optimizing every lever you have, which is critical when consumers are watching every penny.
And you mentioned price pack architecture was a hot topic. Is that related?
Very much so. It's a core part of RGM. Price pack architecture is about strategically designing the different sizes, formats, and price points of your products.
Like offering a smaller, cheaper option or a big value pack.
Exactly. Tailoring the offering to different shopping occasions, different retail channels, or different consumer needs for value. The sources say mentions of this in earnings calls have spiked. Companies are really focused on getting the pack size and price right for the moment.
Another way to manage price sensitivity without just cutting the price across the board. And getting all this right requires data, presumably. Lots of data.
Oh, tons of data. And the profitable growers are significantly more likely, 85% of them, to be investing in collecting detailed data all along their value chain, crucially including data from retailers.
Getting that insight from the point of sale.
Yeah, leveraging retailer data gives them a much clearer picture of who is actually buying what, when, and where. It's vital for understanding the end consumer.
Okay, pillar 1, product mix. Pillar 2, demand generation. What's the third one? Transformative efficiency.
Right, and this isn't just about cutting costs in the old-fashioned way. It's about finding savings and streamlining operations in order to free up money to invest in growth.
So save money here to spend it on innovation or marketing over there, creating fuel for growth.
That's the concept. It's a virtuous cycle. Improving productivity is a massive priority.
Yeah.
96% of execs say so. And investment in productivity initiatives is up for 82%. Cost cutting is also happening. Yes, 64%. But there's a warning in the report about not being too short term. Don't cut muscle along with the fat.
How are they actually getting more efficient and, importantly, more agile?
Simplification is a big theme. Over 2/3 are simplifying their organizational structures. Profitable growers are leading the charge here. This might mean adopting models that are globally governed but executed locally, or consolidating things like finance or HR into shared services.
Less complexity, less bureaucracy. Does it actually make them faster?
Apparently so. 74% of executives surveyed agree that their operational speed and agility making decisions, reacting to market changes, have actually increased recently, and they connected to these simplification efforts.
Interesting. What about technology's role in efficiency?
It's fundamental. Digitalization is key, not just for customer-facing stuff, but for streamlining internal processes, managing complexity better, optimizing operations. 68% are investing in smart tech and automation specifically to lower operating costs.
And where do they see the biggest bang for their buck with digital investments?
Interestingly, the top areas identified for the highest marginal return are marketing and sales, 48% and 38% respectively. So again, it connects back to that demand generation pillar. Efficiency savings are helping fund smarter marketing.
It all links up, and AI is a big part of this efficiency drive, too.
Definitely. 67% are investing in automation, robotics, and AI explicitly to become more efficient. And AI investment generally is rising. 76% are increasing it. And again, where do they expect the highest returns from AI marketing and sales?
Okay, what about the really hot topic, generative AI?
Oh yeah, it's getting serious investment. 89% are putting at least a fifth of their total AI budget into Gen AI, and almost a third are dedicating about half their AI budget to it. They clearly expect significant returns.
Are the leaders, the profitable growers, doing anything different with AI and Gen AI?
It's a subtle difference. They're investing more in AI overall, 85%, and they're moving faster. But interestingly, they're allocating a slightly smaller percentage of their AI budget specifically to generative AI compared to the average company.
Huh. Why might that be?
The report suggests they might be more focused, perhaps applying Gen AI to specific, high ROI back-office functions or targeted use cases where the return is clearer, while others might still be in a broader, more experimental phase, maybe using it more visibly in marketing initially. But the profitable growers expect even higher returns from the Gen AI investments they are making.
Fascinating nuance. Okay, that's a really comprehensive look at the core strategies, product, demand, efficiency, and how tech runs through it all. Let's shift gears slightly and talk about some specific themes and examples the sources bring up. A really clear one is the rise of private label or own label goods.
Yeah, this flows directly from the inflation and cost of living pressures we've discussed. When money's tight, consumers actively look for ways to save, and store brands are usually cheaper than the big national brands.
And the data shows people are actually making that switch.
Oh, absolutely. The McKinsey data mentioned shows around 40% of European consumers tried a private label product recently. And this is translating into real brand, switching in key categories: household cleaning, snacks, frozen food, dairy. People are trading down.
So swapping their usual Tide for the supermarket's own detergent or their regular yogurt for the store brand.
Exactly. And you see it in the retailers' results. UK supermarkets like Asda and Co-op saw big jumps in sales of their budget own label lines. Walmart in the US reported higher private brand sales, with growth rates in food doubling early in 2022.
It's interesting because private labels kind of lost ground during the early part of the pandemic, didn't they?
That's right. It's an important point. In 2020 and 2021, the big established brands often had more robust supply chains. Maybe consumers felt safer sticking with names they trusted during all that uncertainty.
But when inflation really started to bite,
Then the pendulum swung back hard. As the cost of living crisis intensified in 2022, private labels made a really strong comeback. Value became paramount again.
and are they just recovering lost ground or actually gaining share compared to before COVID?
The JP Morgan estimates suggest that in Europe, private label market shares are actually higher now than pre-pandemic in several food categories, like ice cream and soup. In the US, it's maybe a bit more mixed, but they're definitely gaining share in important areas like hygiene products and baby food. The consensus in the sources is clear. This shift towards value seeking is likely here to stay.
Which definitely puts the squeeze on the big brands to really prove their value. Another major theme is the growth opportunity in emerging markets.
Absolutely. For global companies, markets like China, India, Southeast Asia, parts of Latin America represent a huge potential growth engine. You've got faster growing middle-class populations, higher per capita consumption growth than in mature markets like the US or Western Europe.
And you mentioned they might be somewhat more accustomed to inflation in some of these markets.
Yeah, that's a factor. In economies with a history of higher inflation, consumers might be less shocked or change their behavior less drastically in response to price increases compared to consumers who've enjoyed decades of relative price stability.
So, big opportunity. But it's not as simple as just shipping your existing products over there, right? We talked about tailoring.
No, definitely not.
Yeah.
That's a recipe for failure, and the sources stress this. Companies have to adapt their products to local tastes, cultural nuances, and purchasing power. Just repackaging a Western product rarely works long-term.
Give us those fantastic examples again. They really drive it home.
They do. Mondelez launching Oreo flavors in China, like green tea cake, spicy pepper, barbecue pork, completely tailored. Or Kellogg understanding that noodles are a common breakfast food in parts of Africa and marketing breakfast noodles there. It shows deep adaptation.
Spicy pepper Oreos, memorable, if nothing else. What about the logistical challenges? Getting products to millions of consumers in markets that might not have nationwide supermarket chains?
That's a massive operational hurdle. Distribution networks are often fragmented, relying on countless small independent shops. This makes getting products out there, especially things that need refrigeration or have a short shelf life, really difficult and expensive.
And you also have to keep the price point accessible for consumers with lower average incomes, despite those higher distribution costs.
Exactly. It's a tough balancing act. The strategies companies use include investing heavily to build out their own distribution arms in key markets, or forming deep partnerships with large local companies that already have extensive networks. You need scale and local know-how.
Really complex operations. Now, the sources gave us a couple of detailed company case studies. Let's start with Celsius Holdings. They sound like a real growth story.
Yeah, Celsius is a fascinating example of finding a niche and exploding. They're in the functional beverage space, focusing on drinks for fitness enthusiasts and people with active lifestyles. Their main product, Celsius Energy Drink, is positioned around this Meta Plus blend of ingredients they claim helps burn calories.
So tapping into health and wellness trends within the energy drink market, and their growth has been off the charts.
Pretty much. The source mentioned $400 million in revenue in 2022, aiming for global leadership. They've actually been around since 2007 in the U.S., went international, listed on NASDAQ in 2019, but the really steep growth has been more recent.
What kicked that growth into high gear?
A huge factor seems to be distribution. They struck a major partnership with PepsiCo, which gives them access to Pepsi's absolutely vast network. Convenience stores, drugstores, supermarkets, everywhere. That dramatically increased their visibility and availability.
Getting the product onto shelves nationwide.
Exactly. Plus, they keep innovating with new flavors, different product lines like Celsius Sparkling, keeping the brand fresh.
And they're pushing internationally, too.
They are. It's still a smaller piece of their business, but they're actively investing in building partnerships and localized marketing in places like Europe, Asia, and Latin America, where they see potential for fitness-focused drinks.
But they operate in a space dominated by giants like Red Bull and Monster. How did they compete?
They really leaned into their unique selling point, the health angle, being sugar-free, using natural ingredients, appealing to vegan consumers. That differentiation resonated, and securing distribution early with big retailers like Walmart and Target was critical to get established.
What about the pandemic? Must have been tough for a fitness-linked brand when gyms closed.
Yeah, sales dipped initially in 2020, but they adapted. They shifted their marketing focus heavily online, ran campaigns like Celsius for healthcare workers, which generated goodwill and visibility. And importantly, they actually expanded internationally into China and Mexico during 2020.
Wow, expanding during the pandemic. That's bold.
It was. And it helped offset some of the domestic slowdown and position them for future growth. Shows adaptability.
So niche focus, smart distribution, adaptability. And is this translating into profits?
Yes, very much so. Reported net income was $100 million in 2022. A key factor is their high gross margins. They price premium. And they also managed to keep their marketing spend relatively low as a percentage of sales.
How do they do that? Less traditional advertising.
Seems like it. They benefit a lot from word of mouth, social media buzz, influencer marketing, and just strong brand loyalty within the fitness community. That organic marketing is very efficient.
So good margins, efficient marketing, strong distribution, adds up to good financial.
Really good financials, especially compared to the industry average, according to the source. The comparison numbers are quite stark.
Lay them on us.
Okay, for 2022, Celsius's revenue growth was 28.1%. The industry average, 10.3%. Celsius's profit margin was 25%. The average was 15%. And their return on equity, a key measure of profitability, was 35.7% versus an industry average of just 15%.
Wow. Okay, that's significantly better across the board. Faster growth, much higher profitability, a really compelling example of finding a high-growth niche within staples. Now, let's contrast that with L'Oreal, a huge, established global player.
Right. L'Oreal is a powerhouse in beauty and personal care, which is actually one of the faster-growing segments within the broader consumer staples sector. Their growth strategy, as highlighted, relies heavily on acquisitions.
Buying up brands.
Yeah, they have a long history of it.
And
Brands like Maybelline, Garnier years ago. More recently, the source mentions their $2.5 billion acquisition of the high-end Australian brand Aesop.
And the playbook is buy the brand, then use L'Oreal's global machine to scale it up.
Exactly. With Aesop, for example, a key part of the rationale was accelerating its growth dramatically, especially by pushing it into China, using L'Oreal's existing strong presence and distribution network there. It's how they build global market share.
And the personal care market itself is growing nicely.
It is. It's got one of the higher projected growth rates within staples, maybe 3-6% CAGR. Drivers include the growing global middle class, the whole self-care trend, and particularly strong demand for higher-end luxury and dermocosmetic products.
And specific markets are key. India was mentioned.
Yes, India's personal care market is expected to double in size over the next few years, making it a huge focus area.
What about China? Even with the economic slowdown, it's still vital for L'Oreal.
Absolutely. It's their number 2 market globally. And they seem committed for the long haul, even setting up a local investment company in Shanghai to back Chinese beauty tech startups. Shows they're embedding themselves locally, not just selling imports.
And financially, they're strong, investing in the future.
Yeah, the sources note solid financials, good margins. And they highlight L'Oreal's significant investment in research and development, over €1 billion in 2022. Around 3% of sales.
Is that high compared to competitors?
The source specifically contrasts it with Estée Lauder's R&D intensity, suggesting L'Oreal's higher investment is a key advantage, fueling their pipeline of new, innovative products and organic growth.
So a strategy built on acquisitions, writing growth trends, focusing on key markets, and strong R&D. But even a giant like L'Oreal isn't immune to risks, right?
No, definitely not. One specific risk called out is inventory. Their inventory levels apparently jumped quite a bit in 2022 by about €1 billion.
Meaning they produced or bought more stuff than they sold immediately.
Essentially, yes. And the risk there is, if global demand were to suddenly weaken significantly, they could be stuck holding too much stock, potentially leading to costly write-downs if they have to discount heavily or dispose of it.
A direct hit to the bottom line if the economy turns sour. What about competition?
Fierce. Especially in those crucial growth markets like India and China. It's not just the other global giants they compete with, but increasingly, it's nimble local players.
Local competitors. Are they a serious threat to someone like L'Oreal?
The sources certainly suggest so. In China, you have established local brands like Pechoin, but also newer, digitally savvy brands like SkinFuture seeing explosive growth online. In India, it's a mix of traditional local companies, heavily funded startups like Mama Earth, and other fast-growing challengers.
And why can these local companies sometimes outmaneuver a global behemoth?
Often they just have a better finger on the pulse of local culture, specific consumer preferences, and navigating the local distribution complexities. They can react faster to trends. That deep local understanding can be a real competitive advantage, even against a sophisticated global player.
That localized competition is definitely a key risk as companies push globally.
Okay, we've looked at strategies, examples. Let's pull back again and summarize the big risks facing the whole consumer staples sector. We talked about inflation earlier. That's still a major headache, right? Even if they can't just pass prices on? Absolutely. Inflation remains a huge challenge. Costs for raw materials, energy, logistics are still elevated compared to a few years ago. And because profit margins in staples are often thinner than in, say, tech, any cost pressure they can't pass on directly eats into their profitability.
And consumers are still feeling the pinch, even if wage growth is picking up a bit.
Yeah, the cumulative effect of price rises over the last few years means the overall cost of living is high. That constrains disposable income and puts pressure on spending, even for necessities. People might buy smaller sizes or switch brands or just delay purchases if they can.
And the sources detailed the causes of that recent inflation surge. It was kind of a perfect storm.
It really was. A key factor was that huge, sudden shift during COVID lockdowns, from spending on services like restaurants, travel, to spending on goods like groceries, appliances, home stuff.
People were stuck at home buying things instead of experiences.
Exactly. And that massive surge in demand for goods overwhelmed global supply chains, which were already fragile due to things like just-in-time manufacturing and pandemic disruptions.
Leading to bottlenecks, shortages, and ultimately higher prices for goods.
Right. And then, as economies reopened, demand for services snapped back, pushing service inflation up too. Meanwhile, housing costs also surged.
Housing was a big piece of it.
A major contributor. Shelter costs rose much faster post-2020 than before the pandemic, significantly boosting the overall inflation figures.
Linked partly to the work-from-home shift-changing demand patterns.
That's part of the story, yeah. More demand for space, shifts in location. It put pressure on housing markets.
And then the war in Ukraine poured fuel on the fire.
Directly impacted energy prices, obviously, disrupting oil and gas, but also food prices due to disruptions in grain and fertilizer supplies and other commodities. Plus, the sheer geopolitical uncertainty makes everyone, businesses and consumers, more cautious.
So, a complex inflation picture still impacting margins and demand. And layered on top are the ongoing geopolitical risks and supply chain vulnerabilities we discussed.
Yeah, those are now just persistent risks companies have to manage constantly, investing in resilience.
Plus, that intensifying competition, not just from peers, but from those local players, especially in growth markets.
It's winning harder everywhere.
Which leads to what might be the most profound risk highlighted in the Deloitte report, especially for a sector known for stability. The risk of doing nothing, the risk of inaction.
This is such a critical point. Historically, being conservative, moving slowly, might have felt safe in the staples sector, but the message now is that the world is changing too fast. Consumer behavior, technology, the economy, geopolitics, everything is in flux.
So standing still is actually falling behind.
Precisely. Relying on the strategies that worked 5 or 10 years ago is now seen as the riskiest approach. The pace of change demands proactive adaptation.
Companies have to embrace change, invest in new ways of doing things, rethink their portfolios,
Right.
or risk becoming irrelevant.
Exactly. Waiting and seeing is no longer a viable strategy. Obsolescence is a real threat if you don't adapt.
Wow. Okay, we have covered a ton of ground today in this deep dive. We defined consumer staples, looked at why they're defensive but also dynamic, unpacked the complex 2025 economic outlook, dove deep into the new strategies beyond pricing, product mix, demand generation, efficiency, examined fascinating examples like Celsius's explosive growth and L'Oreal's global strategy, and outlined the significant risks from inflation to inaction.
It really paints a picture of a sector that, despite dealing with everyday necessities, is facing extraordinary pressures and undergoing fundamental shifts. It's anything but boring right now.
So bringing it back to you, the listener, why should you care about, L'Oreal's R&D budget or the price pack architecture of soda bottles or the rise of private label yogurt in Europe? How does this connect to your life?
Well, it connects directly to almost everything you buy regularly. It shapes the prices you pay at the checkout, absolutely, but also the choices you have on the shelf, the new products that appear, the ones that disappear, the packaging sizes, even the ads you see.
Understanding the defensive aspect helps make sense of market news or maybe informs how you think about the economy. Seeing the shift away from price hikes explains why companies are pushing innovation or different pack sizes.
Exactly. It gives you a framework for understanding the why behind what you see in the grocery aisle or the drugstore. You can look at your shopping cart and sort of see the ghost of these global economic forces and corporate strategies that put those specific items there. It makes the invisible visible.
Making the invisible dynamics behind the everyday visible.
I like that. I guess the central lesson here is that even in sectors built on seeming stability and necessity, constant adaptation and transformation are now essential for survival and success. The old rules just don't apply in the same way.
Adaptation isn't just a good idea anymore. It's basically table stakes.
Which leaves us with a final thought to chew on, maybe. As these companies get incredibly sophisticated with data analytics and AI, understanding our individual habits, tailoring offers, predicting our needs, how might that fundamentally change our relationship with these essential goods?
Yeah, does the line blur between a staple and a highly personalized service?
Yeah.
And how will that ongoing battle between the global giants and those agile local players reshape what our shopping experiences look like in different parts of the world? Lots to keep watching.
Always more to think about, always more to explore in the world of the deep dive.